Chuck Carnevale, and I'm the Chuck in the Markets Up Chuck. And today's blog post is one that I've repeated many times. It's called Earnings Determine Market Price. It's something that's very special to me personally, because in the long run, it really is all about the earnings of the company. And I've repeated that theme in different ways over and over again during this blog. But I want to try to make it clear that what the market's really doing, what people are really worried about right now, especially because the market's rallied, really does not matter anywhere near as much as how your individual companies are doing. So I'm going to go through some examples here just to show you how important it is to understand what's going on in your individual company and how in the long run it's earnings that determine market price and not what's what the stock market's doing. So the first company I'm going to show is AAR Corp here, and this is in the airline industry, and I want you to notice that the green line here shows their earnings. We had a period here from 1991 up through 1999 where earnings first fell, then grew. I want you to notice the black line is the stock price that followed it. Then earnings collapsed and stock price followed it. Then earnings grew again and stock price followed it. And then of course we had the recession and earnings fell precipitously and stock prices followed it again. So in the long run, it's earnings that determine market price. Now, over all this 20-year period here, which I'm illustrating, this company averaged a 3.3% compounded growth rate. And I want you to notice that shareholders ended up with a 5.5% rate of return, which is very, very consistent with that growth rate in contrast to a 6.4% return in the market. But the point is, it wasn't the market that generated that return, it was the earnings of the company. My second example in today's blog is Cisco, and I want you to notice that Cisco, starting in 1991, had very consistent earnings growth up through 2000, and of course you got to remember that was the irrational, exuberant period where everything .com, it was favored by everybody. I want you to notice the black line stock prices followed that perfectly, but here's where I mentioned in the blog the importance of valuation. The stock price got completely disconnected, so for short periods of time, stock prices can disconnect, but inevitably, as they did here, they will come back to earnings, and once again, you'll see that earnings followed market price. And again, when earnings were growing, price was growing, and then we had these drops. It's never a perfect correlation, but in the long run, it's a very, very powerful correlation. Now, through all this 20-year period, Cisco generated a 29.3% compounded rate of earnings growth, and shareholders ended up with a 30% compounded rate of return, almost perfectly in sync. And here's the real strong point. The 30.3% return that Cisco shareholders are turning $100,000 into $14 million had absolutely no correlation and nothing to do with what the market did over the same 20-year period. The market only averaged 6.4%. Earnings determined market price, and Cisco generated powerful earnings, even though they were somewhat lumpy in the middle. That is really where shareholder returns came from. If you look at Ford Motor Company, all know what's been going on in the automobile industry. You can see, again, a very strong correlation. How well the company does is significantly more important than the stock market. Ford shareholders lost compounded minus 0.2% a year, where S&P shareholders earned, 6.4%. Another example is the importance of earnings is Eastman Kodak. I want you to notice that Kodak's stock price followed its earnings very closely. Earnings actually collapsed here. There is no growth rate. Obviously, it went from $3.31 to a $1.49 loss estimate. Currently the shareholders in Eastman Kodak, even though they received about $64,000 in dividend, turned $100,000 into $12,000. That's a minus 10.5% compounded annual loss. And then, of course, that compares to the S&P, which did 6.4%. So again, there's no correlation between what the company did and what the market did. The market really has very little to do with your individual holdings, other than in the short run, all stocks will move in tandem with the market generally, but in the long run, it's all about earnings. Then to conclude today's presentation on the importance of earnings, here you have a company, Cognizant Technology. I want you to notice that their stock price correlated to earnings all the way up through until we hit the recession. Then we had this big drop in price, and more recently we had a terrific rally. I want you to notice earnings stayed very strong during the recession. The company has no debt on the balance sheet. By the way, generates very strong cash flows. And $100,000 in Cognizant 13 years ago, which is all the history this has, actually since June 30th, 1998, would have grown to $7,732,000. That's a 47.2% compounded rate of return during a period of 12.5 or so year period where the stock market would have actually lost 0.6%. $100,000 would have turned into $93,000. So it's not the market; it's all about the company itself. Even though in the short run the market will have its impact, in the long run it's earnings that determine market price. This is Chuck Carnevale saying thanks for listening, and I look forward to talking to you again tomorrow. Thanks.